Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everybody, and welcome to the Top 5 at 5. I want to give you guys some of the best stock ideas from some of the best money managers out there. No pressure there, Brian. Brian Madden, welcome. Thanks for doing this.
Oh, thanks for the warm welcome. Try and live up to that star billing.
And I should say Good Read Investments as well. Head portfolio manager and strategist. Are you the CEO now as well?
I'm not the CEO. I'm a senior portfolio manager. Gordon Reid is our CEO.
Okay, perfect. So Brian, let's get to this right now. I think that we always talk a lot about macro pictures, but people at the end of the day still want to own some good stocks that they have high conviction in for the coming year. So let's go through your top 5 right now. And for everybody out there, we are going to say the highest conviction idea for last. So stay tuned. But Brian, what's first on your radar?
Well, I think let's start where the action has been year to date in the Canadian stock market, and that's in the oil patch. And so our exposure there in the Goodread portfolios, the Canadian ones managed by me, our best idea in the oil patch right now is Parex Resources.
Tarex. Okay, what's the ticker, please?
Parex. Sorry, the ticker
Parex.
is PXT on the Toronto Exchange.
Okay, and give us a little bit more background in terms of why this company, and with the huge run up that we've seen in oil, and even today on a down day, is how the market started out. And you still saw WTI moving higher and stocks moving higher. Why do we still want to get into this sector?
Well, we think oil prices have been pretty hot lately, but that's in the face of strong demand and question marks around whether idle supply can come back on quickly. There is some uncertainty about that, but certainly what we're seeing is a robust economic recovery, and with it, recovery in demand for things like jet fuel and gasoline and all the other sort of downstream markets for hydrocarbons. So that's why we like the space. And the other thing, not to be forgotten, is positioning is pretty important here as well. So Catherine, we've been doing this, you and I, a long time, and certainly we've seen wholesale carnage in the oil patch for much of the last 7 or 8 years, since about 2014. To the point that, at the nadir, the weight of the exploration, production, and integrated oil companies in the TSX got down to sub 3%, which is a far cry from nearly 30% that it was 10 or 15 years ago. And so that's important, because that level of weighting in the TSX equity benchmark makes it small enough that generalists can just overlook the whole sector and zero weight it. And we think now they're having a bit of a rethink on that zero weighting, and wrap yourself in greenwashing, given that energy was the best performing sector last year, and given where oil prices are today.
And PXT, the ticker that the company that we're talking about here, an oil producer in Canada. You say it's under the radar for a lot of investors. Why do you think that is, and what would be the catalyst to get it on the radar?
Yeah, okay. So we'll start with the first part of the question. So it's a mid-cap name. It's about a $3 billion market cap. So when large investors are looking to deploy money in the sector, the go-to names that they usually start with would be things like Suncor, Canadian Natural Resources, Cenovus, and the big heavyweights. This one is down the capitalization spectrum, so it's not the first one on people's radar for that reason. And the other reason is because it's harder to do diligence the asset. So while the company is listed on the Toronto board, all the production is in Colombia, and they're producing about 50,000 barrels a day down there. And they are one of the lowest cost producers listed on the Toronto board among any of the mid and large cap names, to the point that, Catherine, they actually made money in 2020 when oil was on its knees and most of the rest of the oil patch was cutting dividends, violating debt covenants, and generally in financial distress.
And how do you calculate the geographic risk?
Well, Colombia is not the Colombia of the 1990s with cartels and Escobar and all that. It's certainly not as stable as Western Canada, but in the spectrum of geopolitical risk and in the range of places you find oil, it's sort of a moderate risk country these days that is reasonably friendly to foreign investment. The royalty regime there is pretty investor friendly. Corporate tax rate's not too onerous, and the rule of law is pretty good there. I can think in the last 4 years, there was maybe one brief 1 week or 10-day interruption to production because of unrest in the country. So not too concerned about political risk down there.
Okay. I own a lot of energy, and this is actually not on my radar screen, so I'll take a look. So thanks for that.
I want to add something really also important here that I didn't quite get a chance to touch on. This company, unlike much of the oil patch, is very, very shareholder return focused, rather than just drill, baby, drill, which is the mantra in many of the other E&P companies. And the proof point is that they've retired 10% of their shares in each of the last 2-3 years via normal course issuer bids. They've enacted a dividend. They even paid a special dividend last month, actually. So it's return on invested capital and returning cash back to shareholders. Very, very refreshing for a resource company and an oil company in particular.
Nice. All right, what's the next top idea?
Canada Goose was on the list.
Yeah, and why?
Well, it's not just because we had a world record snowfall here in Toronto yesterday, although this company does come to top of mind this time of year. We like it because this is a bona fide secular growth story in Canada, and there is a dearth of rapid secular growth companies in Canada relative to somewhere like the United States, for instance. Strong brand, time tested, very high quality, caters to sort of the upper end of the mass market and into the affluent category. We think there's a geographic expansion opportunity here. The brand's well known in Canada. Everywhere you look in wintertime here, you see somebody wearing one of these jackets. That's much less the case in New York, Chicago, and other cold northern U.S. cities. Much less the case in some of the European financial fashion capitals where they're opening stores, and very much less the case in China, which is a major growth factor for this company. And then the kicker is they're doing product line extensions as well. So they now are also into footwear, which they launched just a few months ago. To great market reaction. And
I think for viewers to know, you spent a lot of time covering specialty retail companies in your earlier part of your career, correct?
Yeah, so in a former role, I managed an asset allocation fund and was a generalist, but I had a side responsibility to be the firm's in-house consumer expert. And so, I'm pretty deep on the consumer sector, retailers, and the other consumer names.
Okay, and I spent time at the beginning of my career doing as a junior analyst in covering specialty retail back in the States. So let me ask a couple of in-depth questions with respect to Canada Goose. What are the same-store sales trends like, and what are the year-over-year comparisons? How's the stock been performing? What are some of the granularities here on the income statement, balance sheet front?
Sure, yeah. So same-store sales are, the exact number escapes me, but I'll characterize them as being double-digit. The other thing is there's a rapid pace of new store openings. Their total store base globally is only about 30 stores. So same-store sales is a somewhat important metric, but they also have a lot of sales through the wholesale channel, which is other fashion retailers, although they're trying to shift that mix more so towards their own branded stores. It allows for better margins and better brand experience and brand equity building capabilities, which is something they think is important. And then the other thing that sort of clouds it a little bit is, the pandemic forced the closure of a lot of non-essential retail, which of course expensive winter parkas are non-essential, despite what the thermostat might say outdoors. So they've really been successful in pivoting to e-commerce. They actually drive huge growth, against a fairly low base in e-commerce sales in the last couple of quarters, triple digit if memory serves correctly. And then how's the stock been doing? I think right now is a tremendous pullback and a great buying opportunity. It's kind of a volatile stock. And I would say that's the case because this is not your garden variety Canadian consumer name where it's mostly held by Canadian asset managers and institutions and pension funds. The majority of the stock is held by US investors who tend to be a little quicker on the trigger finger. And the stock reacts pretty dramatically when US analysts, a lot of whom covered the stock, take action on it, whether it's upgrading or downgrading. It was downgraded by, I believe, UBS a couple of days ago. It's also had a bit of mudslinging back and forth with the Chinese government about their refund and exchange policy in that country, which they've had to course correct on and liberalize their refund and exchange policy, all of which I think sets it up for, a good entry point here. And the history of this company is when they report their results, which they will be doing on February the 4th, you get fireworks in the market. They've been very consistent in beating earnings and sales expectations since the IPO 4 years ago. We expect they'll do that again in early February.
Okay, I can't believe it was only 4 years ago. It feels longer that they IPO'd. Let's take a look at the next top 5. What's the next stock?
So we've got TFI International, which is a big trucking company, great consolidator of a fragmented industry.
Mm-hmm. And why is that something of interest now? Or maybe it's been a name that you've owned for a long time. And then I don't know how any of the restrictions on the vaccines come into play with this stock. Was there any impact?
Yeah, good question. Lots in there. So I'll start with just sort of our history with it. We bought the stock, I want to say 2.5 years ago in the high 40s, maybe the low $50 range. Unbeknownst to us, there was a wicked pandemic coming down the pipeline that was going to sideswipe supply chains from end to end. So why now? Why do we think there's still money to be made here? I guess the history of the company is the real proof point. This has been a tremendous compounder over more than a decade. It used to be an income trust, converted back to corporate form when income trusts went the way of the dodo bird. But more than anything else, trucking, as you might imagine, is a pretty mature industry. You're not going to get 20-30% organic growth rates. Generally speaking, you get sort of GDP plus or minus growth rates. And so what this company has done is, much like Parex Resources, this company is managed for returns and not just for size and growth for growth's sake. So the return on shareholders' equity is very high. It's north of 20%. They run lean, efficient operations, and they're very active acquirers and consolidators of small, medium, and large trucking fleets. With a big transformational deal, which they pulled the trigger on just about a year ago. They bought kind of an orphaned asset within the US shipping giant UPS. They bought their less than truckload division for about $800 million. This was fantastically accretive to their earnings, 25-30% once it's fully integrated and synergized. And it was, it came at a great time because right now trucking markets are as tight as they have ever been, which means the companies have pricing power in what used to be sort of a commodity price taker kind of a market. But capacity is tight. Backlogs to order trailers and tractors is very long because of these semiconductor shortages plaguing the auto supply chain. And then the driver market is tight as well. One of the reasons for which you touched on, which is this vaccine mandate, which is coming into effect that could tighten capacity even further with cross-border routes, drivers in the States coming out here to Canada. So they're just making an awful lot of money. Consensus has them earning about $6 a share this year, which puts it at about 17 times earnings, which is pretty undemanding for a company that's grown, at a high teens rate for a long time.
I was wondering if the tightened capacity and the pricing power that the company has is priced into the stock. Sounds like from your perspective it isn't. But at 17 times for an industrial company, maybe it is a little bit.
Well, it's sort of trading at parity with most of the other trucking companies, but it's much more profitable as measured by returns on invested capital, returns on
Mhm,
equity, and it grows faster.
mhm.
And so, we think that this is a market, and an environment in which they're really going to make hay and take advantage of that pricing power.
Mhm.
And so generally this has been kind of a beat and raise sort of a company. So, when I say consensus has them earning $6 a share, because they report in US dollars, a big operation in the States here as well. Generally, the history has shown that they typically exceed those forecasts. So the real earnings power here, is likely to be higher than that in our view.
Okay, great. Okay, Brian, we've got 4 minutes left, and remember, we're saving your highest conviction idea for the last. So, and 2 names to go. So, what's the next one on your list?
So the next one is Brookfield Asset Management, one of the largest alternative asset managers in the world, certainly the largest in Canada. Core holding in our good read Canadian portfolios and has been for many years, and I'd expect will be for years to come.
And this stock has performed very well. Do you trim the position, or do you just kind of let it run? I'm kind of curious because time and time again it just continues to outperform. They just seem to run that company so well.
Yeah, I mean, they actually disclosed at their investor day back in September in New York that they have compounded shareholder returns in Brookfield Asset Management and predecessor company, which is Rascan, at a 20% compound rate over the last 30 years. So I forget what that rolled up to, but it was something like a 30 or 40 bagger on a dollar invested in the stock back then. So yeah, prudence would dictate that you trim positions and they get to be an outsized weight in your portfolio. And we apply that discipline to all of our positions, no matter how much conviction we have in the name, Brookfield Asset Management included.
Okay, and just for anybody who has heard of the name but don't really know what they do or invest in, can you give us the one-liner there?
Yeah, it's a big alternative asset manager. They manage about $550 billion across different long duration real assets like real estate, private equity, infrastructure, renewable energy, and a newly launched line of business reinsurance just in the last couple of quarters. So just a great secular winner with the shift towards alternatives and big scale and operating footprint advantage that few others can match.
Okay, and they pay a dividend.
A very modest dividend. I think the yield is sub 0.5%. It's,
Okay.
they sort of take the view that capital is better recycled and reinvested in the business and returned to shareholders. Ordinarily, we don't agree with that mantra, but they have, we give them the benefit of the doubt given their track record.
Okay, and lastly, we've got about a minute left. What's the top idea, highest conviction idea?
Nutrien. So this is Canada's biggest mining company, one of the biggest agribusinesses in the world. They're going to make just a boatload of money this year because with high cash crop prices, corn, wheat, soybeans, we've got very, very, very tight fertilizer markets. So they mine potash, nitrogen, and phosphates. And they've got a great, very large downstream retail farm supply network that's here in North America, in Australia, and in South America. Stocks pulled back a bit in the last 2 weeks on an unexpected departure of the CEO. But we think that affords an excellent entry point, and in time they'll kind of get past that chasm and hire a very capable CEO.
Anything there we need to know about or worry about?
No, I'll just say that the CEO departure was not well telegraphed to the market. It was a second departure of a CEO on sort of short notice inside of a year, so kind of unusual. But Catherine, resource companies are about assets and people, and the assets in this case are 40, 50, 60-year reserve life deposits, world-class deposits of potash, nitrogen, and phosphate. So those assets are going to be in the ground regardless of who's in the C-suite, whether the chair's empty for a few months. And so we think they will conduct a search and hire a very capable replacement for the outgoing CEO. And in the meantime, with the shares off the high by about 8 or 9%, it's a pretty good and pretty timely entry point in what should be a great year for this company fundamentally.
Okay, excellent. That ticker there is NTR. Brian, we're going to leave it there. We did top 5 in 20 minutes. So thank you for your time. A lot of great ideas there with the fundamental knowledge backdrop as well, which I think is so important to share to investors and viewers so they kind of understand why and where you're coming from. So thank you very much for that.
A real pleasure, Catherine. Thanks for having me.
Thank you. And we'll leave it there. Top 5.